Hi, this is Ed Jorgensen with that quick and distasteful market mini crash in December. A number of you have asked about so-called technical indicators, whether one can read from stock action what risks are and what's going on. So I thought I'd do a short video on technical indicators, momentum trading, which is what technical indicators are, and how we look at December. Let's start. So we know that in 3 days in December, the 17th, 20th, and 24th, 3 waves of computer-based stop-loss programs hit the market. Computer programs designed to say sell everything if the market action has certain characteristics or reaches certain levels. But all these programs kicked in at the same time, and they themselves, as always happens with these programs, drove the market down. In this case, drove the Dow down almost 10% in 3 sessions. There was a fundamental background, namely the Fed chairman saying that interest rates were going higher, and that's totally negative for the market. But the particular trading action was technical. I've mentioned several times that Central Bank Chairman Powell's threat of higher interest rates was really negative for stocks. But in this little essay, I want to look simply at the technical trading that produced the 10% mini crash on 3 close days. And what I've done, I've asked my computer, could it create a program that would emulate the aggregate effect of all the programs out there, see if there's in any way we can anticipate, defend, protect ourselves from this kind of computer-based trading. Here's what I found, and I'm a little surprised. Our computers have estimated an aggregated sell point at which the risk of stop-loss programs overwhelming the market becomes quite severe. And if you look at the red line, it's a moving point of where the market is on the edge of triggering these programs as they're written today. You'll see in 2015, it indeed happened. Early 16, it happened. Mid-16, we reached that trigger point, but the market did not trigger. And then in December, we reached that trigger point again, and the market did trigger. So it's a tool that's interesting. So then I asked the computer, all right, can you give us a band at which the recovery from this computer-based trading tends to take the market, at which point we have to decide if the fundamentals will take the market higher. And the yellow line is the band that the computer gave us. And you see it was pretty accurate in 2015, 2016. And we'll see. The band is around Dow 25,000 right now, a little bit above that. And we are close to being at that point. So we have a first very short-term, technically based, market momentum-based issue that's presented to us. I always remind myself when playing with this computer modeling that in the 1970s, when I was a kid, first studying the market and following the gurus, the legendary Joe Granville for a few years used his model. It was a mixture of market momentum and trading volume that absolutely called every twist and turn in the market until the one he needed to call, which was 1982, and his system failed and he remained a bear for 25 years during the greatest market rally of all time. So we have to take technical indicators with a grain of salt. Okay. There are bulls and bears in the market, each using their computers. I'll just show you the classic technical momentum gauges that other firms are using, and here they are. There are various moving averages, some sense of what prices have done. And descriptively, they can be very useful, but the trouble is, history shows that there are many occasions where these indicators trigger a sell signal that in fact is the first buying opportunity in years. So we have to be really careful. Really, these indicators were far more accurate in the 1970s and early 1980s than they've been recently. Then there are some descriptive possible sell levels that historically have been important. Just to give you an idea of what historically the risk in the market, one would say that the risk is now down 20,000, but if you look in the great crash of 08-09, the fundamentals of excessive debt blew right through those levels that the computers would call support, just blew right through them. So again, we take this with a grain of salt. Here are the same measures today, and there they are with one at 21,000, the lower at 20,000. Well, I have to tell you, sometimes it's true, sometimes it's not. Clearly, there are issues on the table here. I just pass this on because a number of you have asked about what the common statistical models of the market say, and here they are. So look, here's my point of view. The market suffered a classic computer-based mini panic as computers at firms attempted to execute stop-loss programs. That is, sell everything because the decline is more than we want to bear, we expected. And it didn't work. They simply fed into themselves and created the decline they worried about. But we don't slough this off. As I said in the January outlook that I just published, in the very short term, a lot of margin debt and other speculation has left the market, and the latest numbers just came in the other day, and that's true. A lot of margin debt has left the market, giving the market some room for a recovery rally. But as that happens and we're close to the first reassessment point, we have to take a look. So there we are. I hope this was interesting and useful. I happen to love market statistics, and I just caution that they are fascinating to follow and study, but they don't provide a fail-safe guide for investing. They're an addition to our arsenal, not the arsenal itself. But I think you knew that. Anyhow, we're coming up likely for several months of back and forth trading, if this is normal, as we reassess the fundamentals of the companies we own. Clearly, there's a recession in Germany. There's something going on in China. I call it a recession. The government statistics don't call it that yet, but I'm not sure they're true statistics. So half the world economy is very rough, and here in the US, we have really extraordinary risks from an unprecedented political war that's going on and increasing weakness and the perception of weakness in the White House. For example, can Mr. Trump, who appears damaged from his latest confrontation with the House Democrats, can he get now a deal with China that's advantageous? I'm not sure. Or will they just wait for 2 years and he's no longer in the picture? I don't know. So we have political risks in the market. We have market trading risks. So I'll be talking to you and going back and forth on how we handle it. Hope it was interesting, and talk to each of you personally soon. Bye-bye now.